This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to go through and just introduce share-based payments. It's IFRS 2. It's a new accounting standard, so one that you haven't seen previously in F7 or F3 for that matter. So let's go through and have a look and introduce what it's all about. So what are share-based payments? So share-based payment is a payment for goods or services. So a company may decide to purchase goods or may decide to pay an employee in either shares. Okay, now, normally we buy goods and we pay for an employee's services in cash, but it could be that we pay them in shares instead. Could be that we pay them in share options. Okay, so the option to buy a share. So we give them the option to buy a share at a particular time or point in time in the future, and that purchase price of the share will be much lower than the actual expected value of the share. So we'll give that option some value to the employee or value to our supplier of the goods. And also as well, it could be that you actually pay cash, but the cash that you pay is based on the share price. Okay, and what we see, and most of the time within the exam, although there could be the odd small occasion otherwise, is that share-based payments are commonly used for awarding your employees. So employees will either be paid just a normal basic salary, a wage. They could get a bonus. They could have pensions that we've seen previously in the last chapter. But on top of that as well, you could be rewarded with regards to share-based payments, i.e. the option to buy shares at some point in the future, or you will get rewarded based upon the share price and a payment in cash. So the higher the share price, the higher the cash payment that you get. Okay. In terms of the scope of IFRS 2, so what does it go through and cover? If it doesn't cover any of these, then it's in a different accounting standard. So here we've got equity share-based payments. So that's whereby there is a payment in shares or share options. If there are cash-settled share-based payments, that's a cash payment based on the share price. We also have potentially a hybrid of equity and cash settled. No, thank you. If we get a chance, we'll add in a session at the end. I very much doubt it, so we shall neglect that and not worry too much about it. It's never been seen in the P2 exam. I'm sure at some point it will appear. If that's the case, move on, do something different. Okay. What we've got then is we've narrowed it down, haven't we? We're going to focus on the basics. Yes, there is the hybrid, but don't worry about that. So share-based payments, there are two types. You have the equity settled and cash settled. Now, first of all, you need to be comfortable with the different terminology, the different names given to them. Equity settled are also referred to as your share options, because share options are usually granted to the employees in return for the service provided. And cash settled are also referred to as share appreciation rights. Remember, cash settled is where the company will make a payment to the employee based on the performance of the share. Okay. So, bit of detail there. Equity settled is whereby the company issues shares or share options in return for the provision of goods or services. Cash settled, the company pays cash in return for the provision of the goods or services. We need to think about the debits and credits. What's the journal entries? Well, we are going to recognise an expense, because if we're purchasing goods or if we are issuing the shares or making the cash payment in return for a service, we have to recognise an expense for the goods purchased or the service that we have used. So under both, we're going to debit the expense. The issue then is where the credit is taken to. So if it is equity settled, we are going to credit equity. So you'll be crediting equity through your other components of equity, whereby if you have cash settled, you'll be crediting a liability, because you are building up the obligation to pay cash as the share price steadily increases. So key bit, equity settled, debit profit or loss, credit equity. Cash settled, debit profit or loss, credit the liability. That's vitally important, particularly if you're asked to prepare a group statement of financial position, isn't it? You want to make sure that you get the credit entry in the correct place. We need, unfortunately, to be happy with some terminology. So we've got a little bit of a timeline there. And what we've got there is, first of all, looking at the grant date. The grant date is today. Okay. And that's whereby between the company and yourself, the employee, we agree the terms of the scheme. So we look at the number of employees who we grant the options to, or the cash settled share-based payments. We look at the number of years that they need to be employed for before they then get the entitlement to the cash or the entitlement to the share options. And we look at how many options or rights they get per employee. Okay, it's going to be more than one. It could be a couple of hundred, could be a couple of thousand. You just need to follow the information given on the question. But that's everything that we know today at the grant date. We also have the vesting date. Now, the vesting date looks at the number of years from the grant dates and looks at when the employee is entitled to the share-based payment. So when you're entitled to the share option or you are entitled to the cash. And that's the key focus of the accounting treatment, what we do between the grant date and the vesting date. There is another date, which we'll see in a moment, but the difference and the period between the grant date and the vesting date is the vesting period. Okay, and that's where we're going to focus our attention on the accounting. We then have what's referred to as the exercise date, and that's when the employer actually receives the share-based payment. So it's probably a small period of time afterwards, maybe a couple of months, whereby you actually then receive the cash, or you go through and pay the cash to buy the share as part of the share option scheme. Okay, but like we've said already, the key bits are to focus on the grant date, the vesting date, and that vesting period. There has been one question in the past that did get us to focus on the vesting date to the exercise date, but we'll touch upon that at a later time when we see it within the past exam questions. In terms of the accounting treatment, like I said, the focus is on the grant date to the vesting date, and the rules are there. We're going to go through and spread the fair value. So those infamous words in international accounting standards, fair value. So we need to know the fair value of the equity settled share-based payments and the fair value of the cash settled share-based payments, which we then spread over the vesting period, so over a number of years. And the third bit there is the important bit. It's based upon the expected number of employees. We may start off with 1,000 employees at the grant date, but 1,000 employees aren't going to still be there in 2 or 3 years' time, are they? So what we're going to go through and do there is we're going to put in a bit of judgment. And in that judgment, we're going to estimate the number of people who will leave in the future and therefore give us the estimate of who will be there on the vesting date. Okay, so a little bit of judgment brings a little bit of ethics, doesn't it? Okay, so what have we got? There's 3 things to think about. The first one is the fair value. So that will be important, and we'll see that in a moment with regard to equity settled and cash settled share-based payments. We need to look at the vesting period. So that's normally spreading it over the 3 or the 4 years of the vesting period. It's normally 3 or 4 years based upon tax reasons. And then we need to make some guesses. We don't need to make a guess. The question has the guess in. We just need to interpret the guess to be able to work out an answer. So we need to work out the expected number of employees who will be there and exercise it on that vesting date. Okay, so how many people do we expect there to be on that vesting date? We make a simple assumption that if they're there at the vesting date, then they are going to exercise it. Okay, but we should worry about what happens between the vesting date and the exercise date when we see the past exam question. Okay, so let's just focus on the fair value before we then go through and start looking at some of the questions specifically within the class notes. This just summarizes the introduction within the class notes. The fair value of equity settled and cash settled, you need to be very, very careful. For equity settled, we take the fair value of the share option, not anything else, not the fair value of the share. Yeah, we take the fair value of the option at the grant date, and we never ever change it. So whatever it is at the grant date, if it's changed by year 1, year 2, year 3, do not move it. Leave it exactly the same. The reasons why are essentially that if the fair value of the option changes, it's the employee who is going to reap the reward of that change in fair value, and therefore the standard takes the view that no further expense should be recognised because the employees worked equally hard over those 3 years. Okay, so we take the fair value at the grant date and do not change it to the fair value of the share option. However, be careful with the cash settled. Remember, we're building up a liability. That liability is based upon us paying cash based on the value of the share. Now, if the value of the share has increased, we need to pay more cash, and we need to show a fair presentation of that cash payment. So therefore, we need to update the fair value of the cash settled share-based payment at each reporting date. Careful. You've got to be careful there, haven't you? Equity settled, we take the fair value at the grant date and do not change it. We leave it there. However, with your fair value on your cash settled, we update it at each reporting date. So it's important that you know the different treatments and also you know the different terminology, because don't forget, equity settled are share options, cash settled are your share appreciation rights, aren't they? So you've got to be comfortable with the terminology and you've got to be comfortable with the rules. Once you know which fair value you're using, you can then go through and take that fair value, spread it over the vesting period based upon the number of employees that we expect to exercise that option. So what we'll do in the following videos, we'll start to play around with some of the numbers within some of the specific examples to do with equity settled and cash settled share-based payments. Before you do, make sure you go through what we've covered there. Make sure you're happy with the terminology. Make sure you're happy with the different types of share-based payment scheme and that you're happy there with those rules about what fair value you use for the two different types of scheme. Once you've done that, come back, rejoin us, and then we can have a little bit of fun playing around with the examples. But until then, goodbye.